Alrighty, good morning, everybody. Today is the 20th, and it is Friday. We got Discord, YouTube, we got what's the other one? Patreon. And the stream is live here, folks, for you. Post your comments, your questions, anywhere you'd like. Would capture them and address them before the end of the session. But got interesting stuff going on right now with the OPEX and the Supreme Court decision. So a lot to look forward to here, folks. If you can hear me fine, see the picture fine. We're looking at this SPY, the 5 minutes chart right now, 686.60. If everything looks fine, hear me fine, just give me a thumbs up, and we're going to begin right away. Okay, thank you everybody for the feedback. Let's look at this SPY. So obviously we have an external factor, shall we say, with the Supreme Court ruling that is causing a bigger move here. And it could have ramifications when it comes to OPEX because the market maker was pricing something to happen, was pricing something to take place in OPEX and a certain strategy. And now this kind of throws all of that in haywire. So we're going to look at the options market data in a minute here. And the initial reaction by the algorithms is positive that the tariffs being removed, that's a positive for the market. So we're going to look at the options market data and make an assessment here of what we see. We look at the SPY, the expiration date is the 20th, that is today. You can see that a lot of calls being bought here overnight, adding all the way to 695 with big number here, 11,962. So they've been buying calls in yesterday's session. The puts, on the other hand, they took the advantage and actually closed. So right off the gate, the formation here suggests that the market has a bias to the upside based on the OI change. Now we'll look at what's going on with the volume that we see. And we see the call volume going all the way as high as 690. So we're not too far for that number. 690 could be a target for today and has pretty high open interest right here. What about the puts? The puts have pretty decent numbers too. A little bit short and shy of the calls, but it goes all the way to 680. So we know that the tape right now favors the calls without a doubt. Now, maximum pain. If the market maker wants to exercise maximum pain in the calls, I mean, look at this. Most of the calls are losing money either way. Most of the puts are losing money. So maximum pain kind of already achieved. But if they want to exercise maximum pain at the end of the day in the calls, they have to dip below 85. In the puts, I would say the number above 85 will do the magic. So I would say that 85 is an important number for the market maker not to sway too much to the upside or the downside from if they want to maintain that maximum pain. Otherwise, there's the risk that you could be sucked into the calls all the way to 690. We have high open interest, high volume. And if you dip it below 685, it could be sucked into the put feedback all the way to 680, which has high volume and high open interest. So I think that the market maker here got caught by surprise, and they're going to try really hard to push it back to that 85. But if they find out that the algorithms continue to buy the market based on the headline that we got, then they have no other choice but to follow the calls feedback all the way to 690. So that's how I see the tape reading today. Now we'll look at some of the big caps. We'll look at here, Apple, any change in Apple from yesterday? Not really. I mean, it is rebounding a little bit, but the day's still young. A negative close again would be problematic for Apple because it's going to solidify maybe that's inverse ABC and a rejection off the 50. So still we're seeing a little bit of weakness here in Apple. And if we look at NVIDIA, I don't expect anything from NVIDIA to happen before the report, to be honest with you. So here in NVIDIA, a lot of folks would maybe sell iron condors right now and receive some credit before earnings. You're not going to receive a lot of credit, though. Microsoft beginning to trade to the downside here a little bit. If we look at Bitcoin today, Bitcoin still not giving us a break one way or the other. It looks like the market is kind of confused about what to do with this piece of news because we know that the tariffs were negative for certain aspects of the economy. Removing them is a positive. At the same time, now you have to pay back all of the tariffs that the government collected. We're talking about hundreds of billions of dollars, not to mention the tools that the president has to fight back against that decision and the kind of volatility that could come with that. So keep that in mind here. Now, if we look at other names, Oracle, that's still weak. AVGO, not doing much here. Looking at the map, we see Google, Meta, Amazon. Those are the ones that are really leading the S&P 500 higher. But we see weakness, a little bit of pockets of weakness elsewhere. If we look at the full map right here, I think this day could be the bottom for healthcare, and we see rotations toward that sector again. But these two, Google, Meta, Amazon, we have to look at these because these are the ones that are holding the tape right now. So now look at Google here and see what it looks like. Google now rebounding. I think it might touch the 50 in a rebound. The correction target is over, and now we have the 20 might cross below the 50 and give us a mini bearish confirmation. I think that's going to happen, by the way. But it could happen after a retouch of the 50. So Google right now probably going to keep the gains from the day. Amazon, on the other hand, I mean, already has bearish crossings across the board here. You have the 20 going below the 50, and you have the 20 going below the 200, and soon enough you might have the 50 going below the 200, which is the death cross. So here, I mean, Amazon could theoretically rebound and close some of these gaps, but it is on the weaker side, to be honest with you. So between Google and Amazon, if you want to follow one of these two, I would say Google is the strongest between the two in terms of the rebound. Now, Meta, on the other hand, do we see anything in Meta here retouching the 50? So that could be the end of the rebound in Meta. So again, between Meta, Amazon, Google, probably Google has more upside than the other two. But I assume that these three names are going to continue to hold the tape and prevent it from going lower too much below the any target that the market maker here is pricing in. Look at the pressure right now, right? Because of this catalyst that showed up, now the market maker is caught by surprise, and they have to accommodate the call feedback. If we look at the VIX, so VXX finally closing the gap. The question now is it still going to be in a pattern of higher lows and higher highs and then breaking to the upside? Or is this it? And we see this tariff decision bringing some buyers into the market and breathing some air into it. I don't think so, to be honest with you, because it's going to be a lot of volatility after this decision. We have yet to hear the response by the president and what he's going to do. And his response might be aggressive, too aggressive for the market to handle. So one step at a time here, folks. But if we look at the movers of the day, movers to the downside, well, we have Akamai, we have Core Weave. Let's look at Core Weave here. Yeah, it looks to me that Core Weave probably going to head back to retest lower support. So we have here at 74 and then 65. If we look at Blue Owl, the pain continues here in Blue Owl. And private equity, Wendy's, that's a no-go still because it is struggling with that 50. KTOS, got questions on it yesterday, but again, that's the high beta in defense, so it moves down more, it moves up higher more than the rest of the defense. I'm seeing a lot of names here going down 1%, 2%, 3%, but there's not a unified theme, to be honest with you. I think it's a lot of options, expirations here, depending on the formation of each individual name. We see moves one way or the other. If we look at the movers to the upside, some earnings, Ring Central, Open Door, some of the components for chips are moving higher. Some of the metals moving higher, but again, a lot of that could be just options expiration that is moving these names up and down, because I'm not seeing a lot of uniformity here in the theme, besides the fact that chips today are coming back a little bit. But we've seen these rotations before, and then they fade away, and we have the big one coming out next week, NVIDIA. So we don't want to make a big deal out of the movements that we see in today's market because of options expiration. So we're going to go back to the SPY right here, folks, and see if we have any unusual activities today, especially after this decision by the Supreme Court, that can give us a little bit of a guideline on what people are thinking. Anyhow, we look here at SPY, sell the 653 puts that far out of the money, though. GLD, they're buying gold at 472, so expecting more upside for gold to come. Gold futures, though, they're selling some calls, so conflicting information here. You can't make a lot out of it. This is really interesting to me. EXEL, because we don't see that name frequently. So here, somebody buying the 40 puts, double buy at the 40 puts. So let's look at this name right here. EXEL. Look at the daily chart. Not sure. I mean, this looks like a classic insider information because there is still above the 50 weeks moving average. Maybe it's showing a little bit of sign of weakness here of a lower high, but somebody probably knows something, and this is a pharmaceutical, so probably a drug trial or a result coming that's not going to be as favorable to the company. So somebody buying those 40 puts as a hedge, maybe an insider or betting against the company. So keep that one in your books here because it looks a little bit interesting that they're betting, making a big bet here on a name that we don't see frequently traded in the options market. Anyhow, let's go back to the SPY, take your comments and questions in this OPEX Friday, folks. See what you guys are thinking. Okay, Mike, from last video you mentioned last night, metals including gold would not be safe haven for war. Does that mean that gold would not have an initial pop? Does it mean the pop will eventually fade? I think you're reading too much into it here. It goes as simple as, where do we see the dollar? So the dollar is going down right now with the Supreme Court decision. That's helping gold a little bit to move higher. But when we talk about the geopolitics purely, if we anticipate that investors are going to buy the dollar as a hedge against geopolitics, that if there's a pop in the dollar, algorithmically, that's going to push gold down. And on top of that, I mean, if you want to hedge against war or against geopolitics, would gold be a good hedge at this point? Would somebody buy gold at this price and assume that it's just going to continue to go up? I think there's a lot of calculation by investors to look at gold and silver differently right now after the rally. So when it comes to the war, if there is a pop in the dollar, my 2 cents would be gold is going to flush and not a pop higher along with the dollar. In the anticipation stage of the war, yes, you could see both of them moving higher slightly together. But after the event happens, if investors decide to go with the dollar as the hedge, and we see a pop in the dollar, I think that gold flushes down right away, based on the algorithmic reaction alone. Okay, please explain what WTF happened. It's the Supreme Court decision. Came out, so now the market maker all of a sudden, like I said, didn't really want to accommodate all of this feedback. They wanted to stay below 85 because that's maintaining maximum pain on both the calls and the puts. But this scrambles the market maker to have to hedge and buy the stock market. So can they just follow the feedback to 690 or do they fight it back to 85? That's what they're trying to do, or at least tried to do for a few times. But it looks at the algos. I mean, look at the volume here. It is still buying based on that news. So the market maker has no choice but to keep the tape moving higher. Mav, do I close my TZA and SQs, or is this a fake out? Looking for a game plan because the market looks very bullish right now. Folks, we actually have to address this in a video because holding the inverse ETFs, I think people think it's just holding the inverse chart of the SPY or the IWM. It's not, it doesn't work that way, folks. It's just the day-by-day movement. Every day, this ETF is reset and is capturing what the IWM is doing, for example. So if the IWM right now, it's still below 265, by the way. It is down about just fractionally here, not a big deal, but you see that the TZA is pricing in 3 times that move to the upside. So Monday's session, that's going to reset again to 0, and it's going to track what the IWM is going to do in that particular day. So it's not going to track, if you're betting, for example, that the IWM here is heading in a downtrend, for example, the TZA is not going to capture that exactly. It's going to capture the day by day And then you have to calculate every daily move. Does it come to a net positive or a net negative for TZA or for S triple Qs? So for now, if I'm holding these inverse ETFs, I have to keep that in my head, because you don't want to hold those inverse indices if there are rebounds or there are rallies, especially if you break above certain resistance. In the case of 265 here in the IWM, you don't want to hold them because you're going to assume a lot of decay. By the point you get one down day or a week worth of downside in the IWM, you already have a lot of decay that it doesn't matter. That you see TZA going up, but it wouldn't matter. It wouldn't make profits for you because you already suffered the declines too. So trading these inverse ETFs requires a lot of skill. It requires going in, out, in, out, in, out, and timing it right every single time. So that's really hard to do. You only want to buy them when you're sure that we have a corrective phase that lasts, for example, here in the IWM, November 24, all the way to April 25. If you have this corrective phase, then yes, it's worth it to hold the inverse ETF. And you're going to see here in TZA, for example, in the same period, you've seen a pop higher. And that was worth holding it. Then you sell it right here. But if you're going to trade it in regular market dynamic, just anticipate you're going to be in a downward trend. And you have to, for example, buy, sell, buy, sell, buy, sell, buy, sell. And you keep doing that. And it requires a lot of skill here to nail every single move. Just keep that in mind. If it's too hard, if it's too much, you probably don't want to do the inverse indices. SPY looks like it's heading to that 690. It's in the bag now, pretty much. And the market maker did not anticipate that that's going to happen, but they got no other choice but to squeeze it higher here, folks. Hey, what software are you using for tape reading in the beginning of the streams, please? Thank you very much. What are you talking about? You talking about this? This is bar chart. But again, you can find the same data in your broker. You just have to use the desktop. I don't think you're going to find it in the mobile or the app. So you have to use in IBKR, for example, you can find all of this information in your desktop. What about Nike and Lulu? This is really interesting because I was looking at both names in the morning, and Nike pulling down a little bit, but boy, it spiked higher here. And this is a signal, by the way, that Nike is trying to flirt with breaking that 200 days moving average. So that's actually a positive, not a negative. Lulu, on the other hand, I mean, again, it's subject to the tariffs, but you see the reaction that initially positive, now coming down like Nike. So let's see how this is going to be resolved at the end of the day. But it could be a positive. At the end of the day, if you look at fundamentals alone, if the tariffs are down at least for a period of time, it relieves these companies from paying the tariffs and it lowers the cost. So I think especially now, we have to give Lulu a little bit of chance. We have to give Nike a little bit of chance to work out here. And you see a lot of these retail, for example, if we look at the ETFs here, you might see that the XRT, where do we find the XRT? Here it is, XRT retail. It might actually begin to firm up because a lot of these retail companies will find some source of relief from the tariffs, at least for now, at least from an investor's perspective. We might see folks buying them. So I would say let's give it a chance here, Nike and Lulu, whichever one you have. Can we find a cheap lotto for a war play, Mav? Well, yesterday we gave you one, right? So you could do USO, you could do VIX. You just have to get your timing right, though. So you don't want to bet too much on these lotto plays. You want to bet something that if it works out, you get paid big, but if it doesn't work out, you're going to face a lot of decay, and you can actually maneuver and move the expiration date or move the strikes or cut the trade entirely. Okay, EXEL, also insider selling is huge. Yep, something is brewing. I don't see names like this before, so might actually follow a trade like this. Again, it's a lotto. You don't want to spend too much on it, but if it works out, maybe somebody knows something, you can flip $4 into the 10, for example. Why not? Lenny, you say you sold the 600 SNDK call expiration date today for $20. So I'm in the red and I'm not yet looking to short. If I roll, what strike and date would you recommend? Okay, this is a good question because, again, do we want to take a chance here that maybe SNDK is going to go down below 600 by the end of the session? Maybe. But honestly, the technicals say that it's probably not going to happen unless the market begins to trade negatively. So with that out of the way, I mean, the more time passes throughout the session, the more decay you're going to see, which is in your favor right now because it reduces your obligation. But let's see here, if we go to the long call SNDK and you sold today at the 600, so that's going to cost you a pretty penny to buy it back. We don't want to take that out of our pocket to buy it back, so we need to sell something else. Let's try 700, for example. And here, this is going to be a buy, by the way. So buy back the 600, and we need to sell something on top of that, but it has to be for a longer expiration date to give us some credit again. And here, if you look at the 700, is it a possibility? Sure. SNDK is a volatile name. It could be a 750 too. So if you're not comfortable with 700, maybe you want to go with the 750 if you can find some credit out of it, but that's going to cost you, so we don't want to do that. The idea here, 720 will give you credit. So 720 or 700 will be the sweet spot here for March 20. And again, I think that NVIDIA's earnings will probably be decisive for these names. If NVIDIA weakens, it's going to be a problem for all of these names that the top might be already in by March 20, and you don't have to worry about the trade anymore. And on top of that, you get to keep a little bit of credit in your pocket. If you choose the 700, you keep a little bit more. So that's what I would do here if I don't want to have the assignment of the 600. But to be honest with you, for me, the 600 is close enough, and I'm okay to start a short here at SNDK at 600. Okay, initial reaction for Nike was very positive. Now losing all of the gains is still fine to hold Nike. 65 calls for March. Yeah, you don't have to worry about that because that's just an algorithmic reaction that is fading a little bit. But the initial reaction was positive. We got a pierce above the 200, so that's actually a positive sign from a technical standpoint because all in all, you're going to perform somewhat such as a bull flag pattern, then move your way higher. Now, again, like I said, we have to see what the president's response is going to be. If he's just going to appeal and going to do all that kind of stuff, then no harm done. But that's going to be actually a positive for these companies because the tariffs are gone. But if he's going to do something more aggressive, that could be a problem. So let's wait and see here. But I see this initial reaction as a positive for Nike, not a negative one. At the moment, it is easier to sell monthly cash secured puts on RIBH, Interactive Brokers ticker, than trading the 3 times inverse ETF. Yeah, I mean, that's another way to deal with it. Trading the inverse ETFs is really challenging. You hold them when you have a corrective phase. If you're confident that, hey, we've broken support in a certain chart, and I see maybe a week, 2 weeks worth of selling, then it's worth it to hold the inverse ETF. But if you're going to try to time it and trade it, you have to have a really good skill in going in and out. And I don't know anybody who has that kind of skill, to be honest with you. Okay, start rebuying ABBV now, or is it cooling down? All big pharma are cooling down today. So if you look at AbbVie at the 50, looks like it's beginning to rebound here. So are we forming yet another ABC? It's a possibility. But I would say that what is the harm in waiting, for example, on Monday before we do that? It's an encouraging sign that we have this kind of candle of reaction of the 50. So another approach, if you want to buy V right now, that's okay with me. But if we lose the 50, you probably want to cut it because we haven't found the support yet. Now it looks like we found it, but if we break below the 50, then we didn't. So if you buy, just make sure that you have your stop loss right here. If we go below the 50, then okay, maybe we need to go a little bit lower and find support right around here. Maybe a little bit lower and find support right around here. So I would say you may begin to nibble on AbbVie. And by the way, it pays a pretty good dividend, I believe. At least it used to, back when I used to own the name. Yeah, it pays 3%. That's pretty good. Hey, Mav, do you see the impact of the tariffs decision in regard of SFR? Thanks. Daily, I like your videos very much. I do like my videos too, very much these days. I think we're doing a lot of we're not doing a lot of redundancy in the kind of stuff that we've done last year. We're doing actually good stuff. SFR, what are you talking about here? Are you talking about certain ticker? Are you talking about the sulfur? What are you talking about? Because I'm not seeing a specific ticker here. Let me know what you're talking about. Swiss franc. Gotcha. Okay. CHF, we call it. Swiss franc, I think that's going to be fine. Because, I mean, if there's a pop in the dollar because of geopolitics, then yes, you'll see a drop. But even then, the Swissy is considered a hedge against geopolitics too. So it might actually go hand in hand with the dollar. Maybe not as strong as the dollar, but lagging. Yet, if we look at the pattern here for the Swissy, for the FXF, still a positive pattern. Still one of the best places if you want to park cash in a retirement portfolio or in a pension portfolio. I think that it remains one of the best choices. So I'm keeping the only foreign exposure that I got in currencies is the FXF, and I have some paper money, the Swiss franc, that I exchanged some of my dollars, so I'm keeping that too. But besides that, that's the only one that I got. My 2 cents here, folks, is the market maker is going to try to push us back as much as they can to that 685. So here we see puts not adding. See, we're not seeing the puts fighting back here. The calls adding all the way to 90. So that could be accommodated. We got really close here. So the highs of the session, 89.17, maybe short $1 here. But I think they're going to try to push us back by the end of the session. Can we look at RTX chart and XLU since it is day 3? So let's look at the RTX. In RTX, if we look at the daily chart, still positive. Looks to me that we still have more highs to come. So you have a bull flag breakout right here. You have probably another bull flag breakout right here. So I see Raytheon grinding its way higher. And again, it's going to be the #1 beneficiary of the war because they're going to get an order right away from the U.S. government. Now, XLU, on the other hand, we stopped at, remember that trade, the unusual trade where somebody bought the 47 calls? Well, they got it. And now I think that maybe we're still forming somewhat of an inverse ABC, and higher we go. So it looks positive to me. I'm not seeing any confirmation here that we have a reversal of some sort. On the weekly chart, it looks like we're just facing a little bit of resistance that we might actually end up breaking above. If you look at the RSI in the weekly chart, it's not really overbought. So bullish momentum is just showing up in the MACD, bullish momentum showing up in the Vortex. So XLU looks pretty good to me here. And maybe it's not ready to break above yet, but it's taking a break. Now, if we, let's say, break the lows of this candle right here, then I would say, okay, maybe there's more pulling back to go. And the low here would be 45.51. But so long as we're trading above, my 2 cents is the XLU will give it another shot to break above that 47 number. Okay, hey Mav, any more downside to PLTR and Palo Alto after today's activities? So PLTR, I mean, that doesn't really matter for PLTR because it has its own dynamics now. PLTR closing the gap right here, but probably going to begin to reverse after that. So I see more downside coming for PLTR. I see it in the options market data, I see it in sentiment, I see it in psychology, in the fundamentals. All roads are leading for lower prices for Palantir. Now, Palo Alto, on the other hand, I know a lot of folks want to buy it, but I would say I'm not comfortable buying it here, to be honest with you. I need to see a clean retest of the 200. I think this is an oversold rebound. It may close the gap, but then come back down and trade negative again. So Palo Alto to me is leave it alone. Not a buy right now. Even a lot of the software names, you look at CRM, for example. When we think about software, that's still not giving you a signal here that we're out of the woods. Best name in software, ServiceNow, still not giving us a clear signal. So cyber, with exception of perhaps maybe net. There we go. Net is the only one that looks positive here because maybe you have an inverse in his shoulder, but you begin to break to the upside. But besides that name, yeah, I'm not seeing it. Avoid Palo Alto. Okay, Mav, trying to decide about the SPY. You have the 27th, that's next week. You have 685, 680. That's close enough. You might actually go down to 685 by the end of the session. So the next one is for March 6. SPY 680.75. Yeah, see, that's the next step. So you don't want to jump 2 steps at a time. And I mean, I know if you're betting on a correction or a flush, you probably want to have a trade like this. But now we have a positive reaction from these tariffs. So I would stick to that 27, the trade for the 27th, see how that's going to work out. And then you have the possibility to roll it again to March without the decay that could happen between now and then. So I would say cut 1, the trade for March 6. Keep the trade for the 27th, though. Also, would you add a short-term hedge? Could you give me an examples? Okay, so we don't want to spend too much money on the hedge because if you get it right, you're probably not going to make money because your main trade is losing money. And if you get the hedge wrong, well, that's an extra cost you paid on top of the main trade, and now you need a bigger break-even target than before. So we don't want to spend too much time in the hedging. I think the best hedge right now that you can do is to eliminate one trade, to eliminate your exposure, reduce your exposure a little bit, just keep limited exposure for that trade for the 27th. That's what I would do right now. Okay, did the stream cut off? I think the stream is fine. Not seeing anything here, folks. Carvana, we have a question on Carvana. We do Carvana right here, daily chart. Look, it is a little bit oversold, so if you short it right now, just expect that you could have a rebound coming, a retest to the 200. Meaning, if you're going to open a short position, you have to open one increment right now. If you're going to buy put options, you have to pick longer expiration dates and maybe have a hedge using naked calls targeting the 200. If you're not comfortable opening another way, by the way, you open the call or the put options rather. You open the options via increments. So you enter one portion of the puts. Let's say you're buying for April, and then let's say it rebounds. You add a little bit more. Rejected, let's say it goes all the way to 200. Rejected, comes back down. Then you add another increment. Then you cut below the lows. You add another increment, and now you have a full position that could actually pay off by the expiration date. So that would be my approach in handling Carvana. But right now, I mean, you look at the RSI and the daily chart, it's getting a little bit oversold. So I would not eliminate the possibility for a rebound because nothing is going to go in a straight line to the downside without a correction. SPY looks like maybe the feedback coming to the market makers saying that the folks at 690 are closing their positions and booking profits. See, now the calls are in the money, right? They're making money now. Thank you to the Supreme Court. So maximum pain achieved in the puts, it was in the morning against the calls, but not so much right now. So the objective of the market maker is to try to exercise maximum pain as much as they can on the calls to see some red numbers here. So they're going to have to pay, but they don't want to pay everybody. So I think they might try to push it down here at that 685, close to that 685, as much as they can. It could be harder because the algorithms continue to buy based on the tariff headline. GM, we talked about worth adding to the CHF. Yes, it's a safe haven. If there was the Iran war could pop the dollar though and push the Swissy down. So maybe you don't want to add all in right now. You want to add a little bit and then wait till we see what's going to happen with this geopolitical outcome. But the Swissy is safe. The Swissy been doing pretty good and it's been tested time and time again. I'm very comfortable having that position in my pension. It's quite a big position, not a small one. Morning, Mav. Thank you for the great videos and insight. Wanted to ask about CCI and AMT, long-term or short-term buy. So these are the best in the real estate Crown Castle, which has been underperforming, to be honest with you. But now a lot of folks are asking if this is an opportunity to buy Crown Castle. And I have to say that, yes, it could be. You have a company paying 5%. And again, their exposure in real estate is pretty diversified. It's not really too much in let's say, high interest rate debt like offices and residential. So I would say I would give it a shot here. I would give Crown Castle a shot, but American Tower is much higher quality than Crown Castle. So between the two, if you have to pick one, I would say pick American Tower because it is known as a classic defensive over Crown Castle. If you want to have both of them, I would say have, let's say, 70% of your money in AMT and the rest in Crown Castle because Crown Castle has more exposure to the cyclical economy versus AMT. Okay, Mav, buy Hershey's or still in a correcting process, especially after the alleged ingredient change. It's just why I don't think the ingredient change is hurting them much. I mean, it was a byproduct of the fact that cocoa prices went higher. I would say that Hershey's right now, I worry about this gap a little bit because this is a classic name that shouldn't leave a lot of gaps open. So I worry about that gap, but what if we are just taking a break and we're readying for another move higher? So the same approach as AbbVie here. If you want to buy Hershey's, that's fine. But if we take the lows right here, so you have support here at 214.62, you have another support here at 214.5. Let's call it 214.5. You begin to trade below that, then it's in the bag that we're going to close the gap right here. So you can buy with a stop loss at the lows here again, 214.5. I would make that 214.40 or 214 even. If you go below that number, then you should be out of the trade. But right now, I'm sticking with Hershey's. It's working out, and I think that in the weekly chart, which we don't have to worry about the gaps in that one, I see here the 50 beginning to curve its way higher to cross above the 200, which is a bullish confirmation, and it already happened in the daily, so I'm going to stick with Hershey's here and anticipate a retest of the all-time highs. Let us know if we might see another rally to new highs. I actually just sold some calls on the high flyers when the IVs were high, like SNDK 1,000 calls. Okay, that's in the bag, right? Yeah, but we're seeing crazy moves. I got you, but we have NVIDIA's earnings coming out next week, okay? And I think that's going to settle the deal. At least throw a little bit of a scare into these components. And at the end of the day, we've seen the big caps not performing pretty good, and the message is going to be received. So everything is lining up in your favor that these names like SNDK and Lumentum and all of that, they're going to begin to trade down. It's just a matter of when, not if. So I think your 1,000 right now is safe, and you can at least collect some premium out of it as the decay continues to kick in. So that's a pretty good trade, actually. When you get a trade like this, let's say you buy a put or a call, and then you open a spread on it that pays you more than what you paid for, you keep that trade. You don't worry about it because you got a good one. And here, when you sold a naked call at such a high implied volatility, you got a good one. And you're probably going to receive at least some of that credit before the expiration date. Hey, Mav, can you please look at MACD and daily SPY? Appreciate your guidance. how and when would to use it, as it looks like it's bottoming and is contrary to the 4 hours in the E-mini? That's a really good question. So look at the daily here. You're looking at the daily MACD, and you're saying maybe we have a bullish cross and the market trends higher. And maybe you're looking at the 4 hours right here in the SPY, and you say, wait a minute, that looks like it's going to cross to the upside. Maybe that is the case. But the continuous contract is more important because it's trading continuously. And here, if we have a crossing, if we have a bearish crossing right here, it's going to reflect on the SPY. So you want to use both of them. The SPY more for the day-to-day trading. The E-mini futures more for longer dated trading. Let's say if you're buying options, for example, for a month from now or 2 months from now, then this chart becomes more relevant to you. But if you're trading, for example, weekly expirations, or you have a trade that's going to expire soon, or you want to do a short-term move, then this chart is more relevant to you. But you can see here, see the crossings are not very significant in the 4 hours. It does not give you a clean signal, as you see in the E-mini futures. That's the beauty of the E-mini futures, give you clear signals of down phases and upward phases, as we see right here. And they're pretty reliable. So if we see a crossing here and we see red bars in the 4 hours, just understand that if you're looking for March 20, for example, the chart is saying you should be bearish. Here it is, market makers trying here to bring it back to 85 because they did not expect that we're going to have a move like this, but my 2 cents here is we have a tweet coming, presidential tweet, in any minute now. Okay, hey Mav, do you still have element? Yeah, people ask me that question every day. Listen, I used to work at a hedge fund where we shorted stuff before the financial crisis, and we were down in the positions by more than 100% plus before these positions worked out. So, yeah, I'm not going to cut these trades when I have strong fundamental conviction that they're going to crash. If anything, I'm just going to keep adding to the position and build that position. Now, as I said before, I think that's my biggest mistake is I just announced, this is why I'm not going to announce anything anymore until we get a guideline video on how to short. My problem is that I announced these positions assuming that people know what they're doing in terms of shorting and how to manage these positions and whether they have the tolerance to be in these positions to begin with or not. People followed just, hey, Mav, shorting the momentum. That means it's, it's going to crash right now. And you find out that your way of managing your tolerance, your account tolerance to manage the margin requirement is not as good as mine, for example. So I think that's a big mistake. We're not going to do any more of that until we give you a clear guideline on how to short and how to manage short positions. But again, am I still short momentum? Yes. LIT right here keeps still a momentum name, keeps going up pretty much every day. In a big way. So if you shorted, you're having a margin requirement right now that keeps increasing. Every time you up your average though in the short, your margin requirement is going to be reduced. But the question is, do you have the cash? Do you have the enough margin for your broker to allow you to average up on the short like this? At some point, it's going to top. It's going to come down crashing. We've seen these kind of charts before. They don't reflect the fundamentals of the company. They're just pricing in future growth based on the capex spent by the hyperscalers, and that's going to be reduced. If you disagree with that thesis, if you think, no, the capex is still safe and we're not going to see that, then there's no reason for you to be in this short at all because you're not betting on the same thing that I'm betting on. So that's another thing that is important for folks to do before they follow anything. Do you agree with what I see or you don't? And if you don't, that's fine. You could be right at the end of the day. But I see a lot of folks who just follow blindly without asking these questions. Anyhow, let's go back to the SPY here and see what we have. 87.20. Let's see if the market maker can pull it all the way to 85. That'd be amazing. If they can't do it, it's an illustration of the power of the market maker. Momentum, GLWS, all of these data center stuff, they can still be strong. And that's the problem of shorting momentum. Any momentum names, any names that are still bubbly, they're still bubbling, Yeah, there's a lot of pain that comes with that. And as I said before, I remember names that we shorted back when I was working in the hedge fund before the financial crisis. We were down, we were under by more than 100% on the principal that we shorted. So, but we held on because we knew that these financial institutions specifically will blow up at the end of the day, and they did. And the shorts paid off. And the person who used to manage the hedge fund at the time retired in 2012 as a really rich guy. Is it safe to sell NVIDIA? Next week, 200 covered calls. Yeah, if you have NVIDIA shares, I mean, you have to do it either way, just as a hedge. Can we go to 200 if there's a pop? Sure, but we tried to do that before in better circumstances, and it didn't work out. So is it safe? Yes. And again, if you go 200 or above, you can manage that trade again. You can sell it, you can buy it back, and then sell something else. So it's a safe strategy. I don't think you're going to face a lot of problems with that. Especially if you're a shareholder, you got to do it. Matt, from what I understand, you see silver correction all the way to the 50, even 50s, even with the Iran situation. And also even without the Iran situation. But what about the tariffs now? The dollar looks weak. I think that's going to have a temporary effect. I mean, you see the dollar rebounding already, right? So, because Trump has tools to fight against the decision, and that's what he's going to do here. We're just waiting for the response. Now, there's still V still trading in range above the 50, so a little bit concerning, but we traded above the 50 again, only to come back. At the end of the day, there's still the correction in this name is not over. There's still some of that excess from that move that the rug pull didn't fix. And there's probably another one that's going to have to be done to fix it. I don't see these as reliable assets right now. If I was managing money right now professionally, I would sell all of my gold and silver. I would have done that as I did before we've seen this rug pull. And I would not buy them right now at all. Now, would I short? Yeah, I would keep a short position at least in one of them, specifically silver, but not gold. You'll see in times in geopolitics, specifically heading into a geopolitical event, you will see that gold is going to be relatively stronger than silver because gold is the one that comes on the top of the mind of investors. Think about it as the LMT of metals, right? When people think about war, the first sticker that comes to your mind is LMT. That's why people buy it, even though fundamentally it's actually weaker than NOC. But it's weaker than the other defense contractors. Why? Because Lockheed Martin has higher cost than the rest. But it just comes up in the top of your head. And gold has the similar effect here. When folks think about war, they think, oh, I should be transferring money to gold. But the truth is, right now, it's not a reliable hedge against these kind of events anymore. Okay, where do you see Amazon and Google topping if we are playing a rebound place? So Google, I think the 50, right? Google is probably going to reach the 50. And again, it's the strongest of the bunch in my opinion because it has the best earnings. So here, I think we have a retest to the 50 at least. Now, Amazon is a little bit challenging. So if you have to choose one of the two, I would say stick with Google, not Amazon. Amazon might fix some of the oversold conditions. Let's check here on the RSI, oversold conditions. And then the Bollinger Bands expand, and for all you know, Amazon sinks again. At the end of the day, Amazon is a consumer company. I know this is not important for you because you're not trading based on the fundamentals, but you're trading based on the technicals when you have a shorter dated trade. But it also factors in which one, when you want to refine which one you want to pick, I would say go with Google if you want to play a rebound versus Amazon. Market maker doing pretty good progress here in trying to get closer to the maximum pain target. Should I buy the dip in the XLE? That's a tricky question because if you get the event, sure, yeah, we would see another pop in the XLE. So it's going to be pull back higher, pull back higher. Now, the GDP report that we got today is a little bit concerning for energy. Because we talk about that economic weakness, right? And the GDP is weak. Now you have to balance it with some of the bullish factors. So you need that geopolitical event to keep the holders of energy from not taking profits. Because right now, everybody who's been holding energy, let's say if you bought it at the beginning of the year, you're tempted right now, and we have a lot of viewers right here who bought energy names at the beginning of the year, made big profits, and they say, hey, look, I'd like to sell here. I'd like to book profits. So that's on the top of the mind when you look at the psychology of a chart like this. The holders want to sell, but they're also saying, what if we have more gains? We don't want to leave it all on the table if there's a geopolitical event. So maybe they're selling a little bit, but they're not selling all. And we see other buyers stepping in. What I'm trying to say here is the risk versus reward for you to jump in is not as attractive as, let's say, here or even here. So you just have to keep a tight stop loss when you enter a position like this. I would say if we head down below this pattern right here, so we have a gap, we went down, and then we headed higher. We see the wick right here. So we didn't stay too long below that number. I'm going to take the low of this candle right here at 53.76. And I would say that it's okay if you want to buy right now, thinking that we go higher because of geopolitics. But if we trade below that number, then no, the holder is going to sell more and book profits, and you don't want to stand in the way of that. Dear Mav, EQT, please. EQT, we talked about that yesterday, right? EQT looks pretty good. So weekly chart, right? We're challenging the triple highs. And the chart would not do that, especially after losing the 50 weeks. They're going to come back above just to stop at another top and then flush down, right? You're coming up for a reason. And that reason is you want to break above. So EQT is a buy. And if you have it, you want to hold it. Okay, no problem with the margin. Look, if you don't have a problem with the margin, I understand. Look, it's painful for me. Okay, my margin is increasing, and I'd rather use the cash for something else. But I'm confident this is going to work out at the end. If we continue to average up into it, it's going to pay big at the end of the day. It's just going to be one of those challenging positions. So what you need to do right now is thinking about your portfolio. If the margin is not a problem right now, and you can average up, would that lock in some of your money from immediate opportunities in the market that you could do right now? And if that's the calculation, then maybe you need to rethink that position. But if that's not a problem, you still got a lot of cash and you have liquidity for immediate opportunities right now, then you keep that position because it's going to pay off at the end of the day. Hardware bubbles at the end of the day, folks, they don't last too long. They can go as aggressive as they can. At the end of the day, they don't last too long because the demand is not going to be as high as it is right now in hardware. Supply comes in, competition comes in. That demand also softens based on macroeconomic reasons, based on micro reasons for the company itself. Like Meta, for example, will have to cut spending at some point really soon, and that's going to detonate the bomb in all of this AI data center bubble that we see. So hold your horses here. We're going to look back. Let's say we're now in the year 27. We're going to look back, and all of these names crashed. Some 50, some 40, some 70%, and we'll be fine. Mav, is it hard to see a top in silver now that's above 50? No, it traded above the 50 before. It's a little bit of a concern if you have a shorter dated put option trade, for example. It tells you that you have to manage that trade, and maybe you need to extend your expiration dates or have a hedge against it. But it doesn't tell you a lot if you, let's say, have a longer dated short, or you have an inverse ETF, for example. We're not making higher highs right now. So I would say stick to the same outlook that we had yesterday. That the dollar is probably going to recover. Today we see gold and silver moving higher, but you see the dollar already finding a footing here. Because the Supreme Court, that's an algorithmic reaction, but at the end of the day, it doesn't change the fundamentals of what the dollar really cares about. The dollar cares about the Fed policy. And the Fed policy right now is hawkish, especially after the data that we got today. The PCE was almost 3% for the year. So that's going to firm up the dollar, whether we have the Supreme Court on tariff or not. It's not going to matter too much. So I would say stick to the outcome that we have been talking about. The dollar is going to head higher, and metals are heading down. Got to remember some of the bets that we've seen. Copper, for example, some folks are buying puts against FCX. All of that is happening for a reason, because folks say the metals rallied too much and the dollar is going to begin to firm up and cause corrections. Gold and silver are always going to be tough versus the other metals. So you see gold and silver outperforming today in a day like this. But once the dollar finds a footing and trades positive again, I think they join palladium and platinum and copper to the downside. Okay, how do you expect the situation to unfold in the coming weeks? In your view, what will be the primary driver for the market? The tariff decision, GDP data, or PCE figures? Okay, so the GDP data and the PCE gives us what we already knew, just a confirmation of what we already knew. And by the way, it brings a lot of questions about the CPI that we got, because the CPI was tame and showed energy down. There's a lot of questions about that CPI, especially when the PPI came way hotter. And then the PCE for December comes hotter. So something is off with that CPI reading that we got recently. But it confirms what we already knew, that we have stagflation and the Fed is going to be more hawkish than we anticipated. So that's going to be the same thing that we've been pricing in already. The tariff decision, yes, it could cause short-term volatility, as it did today. It was volatility to the upside. Now when we see the response by President Trump, that's probably going to cause another wave of volatility. But what's going to matter from this point on? Got to stick to the fundamentals. And what's going to matter more than anything will be NVIDIA's earnings. And if NVIDIA shows signs of competition, that these companies, the CapEx is now not being spent on them, but rather spent on other companies and making their own chips. If NVIDIA goes down, I think that's going to be more important than anything for the market. It's going to begin to revive that AI fear. So we're going to have to revisit the wall of worry and say that the AI narrative is now the number one concern in the wall of worry. So I think that NVIDIA's earnings, that's the most important factor for the market right now. For silver, 37% correction from today's price range. Yeah. And I think that's going to happen in time, though. So the juiciest flush is already out of the way, which is this rug pull that we got. The next visit, the next decline in silver is going to happen gradually. It's not going to happen in a flush like this. So folks who are holding the inverse ETFs needs to keep that in mind, because it's going to have to trade it now. You can't just own it. You can own it right here in a flush like this, and you get paid pretty good. But if we have a gradual decline in silver, you're going to have to trade the inverse index pretty good. So in this circumstance, if you agree with me, this is going to be the scenario. I'd rather be in SLV puts, not hold the inverse index. In a flush like this, I'd rather hold the inverse index, because you get big gains in 1 or 2 days. You get 30, 40, and we've seen 50% even. If you look here, let's look at the ZSL. That's the inverse for silver. Go to the daily chart, and let's make it here. Take a measurement. And you'll notice here that that rug pull got us to 80% worth of gains, right? Even with the declines that we've seen recently, you're still up about 32, 33%. But you don't want to wait till you lose all of that, because silver is just rebounding 1 or 2% a day. And this is why you have to trade it right now. You have to sell at the pop and buy at where we see silver SLV facing rejection and beginning to turn its way down. Okay, the SPY back again. Maybe forming here. Let's see if this is a shoulder, head, and then we form another shoulder and head down after that. I think the ruling by the Supreme Court is positive for some companies, specifically in retail. So you see the pop, now it's giving it up. Macy's giving it up. But to be honest with you, if this is going to stick, let's say if Trump's response is not as aggressive, I think you see a rebound in the XRT. I think you see a rebound in a lot of these retail names that are exposed to the tariffs. So keep an eye on them. This could be a decent trade here coming. Okay, thank you, Mav. Was asking if you can explain the logarithmic MACD trade indicator for the SPY you showed us. Could use a reminder on how, when to look at it in this view. Yes, so we talked about this before here. It's more applicable to the weekly chart, right? When you change it to this look right here, because you want to look for the clean breaks, right? Clean breaks, when you begin to see a break like this, that's a big short for the market. That's a big buying opportunity. So now, are we close to that point? Not quite, but it's splitting, right? It's showing signs of weakness. We see negative impressions beginning to show up as we've seen here, but we don't have that split quite yet. Once you see it, that's going to give you just another visual, by the way, of it's the same MACD, really. It's just giving you a better visual. So by the time this one is closer to the zero line, which is, by the way, it coincides with the 50 weeks moving average, you're going to get your confirmation in the logarithmic that you have a bear phase right now playing out. And that could be a little bit too late, though, because you see here the confirmation came after we got a little bit of decline. But then you had plenty of juice if you wanted to follow the move after a confirmation. Okay, so this is going to give you a confirmation of a move that already happened. And if there's more juice to it, usually there is, you can trade that. But if you want to anticipate, if you're in the anticipating business, you have to rely on the actual MACD right here. Okay, at this point, how far out should our bet to the downside be? I've had shorter term puts. Shorter term is not going to, you have to go to March 20, right? March 20. And let's see how this is going to play out first, though, because the market maker is getting squeezed here with this Supreme Court ruling. Let's see how this is going to work out. If we, let's say, close below the 50 again, then that's going to be a confirmation that forget about it. We have a break to the downside. And at that point, whether you pick 666 or 670, you're better off going to March 20 and opening a spread, because the premiums are still way too high for the SPY puts. And we don't want to experience decay by buying naked. We want to open spreads right now. Okay, how is Dollar General looking right now? It's still looking pretty good. I'm not seeing any change. I'm not seeing that we lost the 200 weeks moving average. I'm not seeing any sign to worry about DG right now. If we lose and close below for the week, below the 200, I said I'm going to book my profits. But right now, keep it as it is. Okay, you have the SLV 60 puts for March 20. Is that far enough to be safe? SLV right now trading about 74. Is it safe 60 by March? Yeah, it is, because you have time, but it also requires management. Meaning, let's say that we trade closer to this reaction right here. We pass above. You probably don't want to have that trade, because by that time, let's see, even if you have declines, if it rises a little bit higher, then you have declines in March, it might not go to 60 or below to pay you for the trade. So it's okay to keep for now, but it's going to require management. At some point, you have to cut loss. So here, if you trade above this reaction right here, so let's call it 77, I would probably remove the trade, because 60 will be a little bit too far. And an appropriate strike would be 70 or 65 at that point. SPY coming back again. I really do see a rug pull happening in silver, but my game play here is to keep averaging on my ZSL, even though, yep, I mean, you could do that, but there's going to be days we're going to face a lot of pain. And let's say you get one big day up day in silver. If silver goes up, let's say 7 or 10%, at some point it might actually eat away all of your gains. Even after the big flush that we already got in silver, because of the day-to-day phenomenon of the inverse ETFs. Let's say you get one upside day of 10% for silver. Now you're down 30%. Your position goes negative. Even if you bought it before the rug pull that we got in silver. And then let's say that the declines that happen after that in silver will be gradual. 1% a day, half a percentage point a day. At that point, you're going to see your ZSL position decaying in value and not gaining much. So you're just holding the position for a long time, but you're not making money. At least not worth it to hold it for that long. So, and you say you're already down 15% in ZSL. So you have to be careful with that assumption, because I think it's going to be more of a gradual decline, not another rug pull in silver that's going to happen in a day like we've seen before. You want my advice? Be honest with you. I think you're better off, because this is going to require a lot of management. I think you're better off if you see another decline in silver. Let's say next week we see a drop in silver. I would say get out of ZSL. Hopefully you can get out of profit at that point and switch your bet to SLV puts instead. Hey Mav, I'm looking to start a position in ENPH. Do you see it coming back to fill that 40 gap? I think we talked about this one right here, and it still looked good last time I looked at it. So ENPH broke above the 50 weeks. You're talking about a gap here for 40, right? So it's not really 40, it's actually below. Do we see it going back all the way there? Your confirmation is going to be if we break the lows right here, because we found support, right? So we have 43. If you break that number, sure. It's a conclusion that we're going to have the next support at the 50, which will be around that closure of the gap. But so long as we're trading above, I think you have to give it the benefit of the doubt that it could be consolidating in a bull flag and it's readying for another move to the upside. So right now, let's say you want to buy ENPH. That's okay. But your stop loss should be 43, because once you trade below, you're going to head lower to the 50 days moving average. And maybe buying it at the 50 would be a better decision than buying it right here. But what if? What if it just went up, corrected, and then it's going to head higher again, and you don't want to miss on that? So it's okay to start a position right now, but this is the importance of having a stop loss from a technical standpoint. SPY back at the highs of the day now. Mav, can you change the setup stream recording to keep recording off the chat as well? They're quite useful to read. Yeah, when you look at the stream after, I think you can see the chat popping up. I'm gonna double check, because I think there's a setting that you have to, but I can see it at least. Maybe I can, but you can't. So I'm gonna check on that. Should I sell some puts for 6 March, 13 March, and Dash to offset my 160, 170 March puts? So you want to open a spread here, right? You have 160, you have 170, and you want to sell another put because you're experiencing a little bit of decay here. I would say, to be honest with you, I mean, these are still good. 170, 160 still within range. You have a rejection candle right here. It might be a little bit too early for you to open those puts, and you might not get compensated well for them. So I would say let's revisit this Monday, right? Because by Monday, this could be an options expiration reaction. And then you head down again. And if you head down, you're going to be in a better position to open these put spreads rather than doing it right now from a point of weakness. And again, the chart is not doing any confirmation to say that your position is wrong. If anything, it's giving you a confirmation that we have a pop after earnings and got rejected right away. SPY, highs of the day. So we see that 690 now. Look at that, 217,000 contracts. And this is delayed, so we're probably at 250 right now. So they have to accommodate that, at least get close to it, and then try to push back as much as they can. The puts are not a threat here. The puts are not a threat until we dip below 685, because that's high volume with high open interest. So looks to me that market maker right now deciding to, hey, I got to go visit that closer to that 690 before I try to do any maximum pain. Keymaster, thank you so much. Weather is going to be a lot better. I think that's the end of the winter season, by the way. That storm that we got. I think that's going to be the end. Good morning, Mav. Do you have any correction target for TYL? Do you believe it bottomed? TYL showed signs of life, got good signs of life after the report, but I'm still not trusting this reaction because it's coming at low volume, tick by tick by tick, and it could actually have another flush down coming. So we're not out of the woods here by any mean. If you average down, for example, and now you're positive or close to break even, I would say get the hell out because software is not finding the rescue that I thought it would in this time frame. Maybe later on it will find a rotation, but I think that as I think about it more, I think that software will find buyers once we see chips going down. So we see a rotation out of chips into software. What would be the catalyst for that? I think it could be NVIDIA's earnings. So if NVIDIA comes out weak, a lot of investors are going to get out of the semiconductor names and they might find the opportunity in buying the dip in software. But right now, I mean, Tyler, I'm not seeing it. I'm not seeing it CRM. I'm not seeing it ServiceNow. I'm not seeing it in the top names. Even if you look at Shopify, which is not really a software, but it's lumped within the software. Got a rebound, but still in the weaker side. So I'm not seeing here that we're out of the woods in software. So with Tyler, I would say if you're close to break even, you're lucky and just get out right now. We revisit it again. Maybe it's going to be a good buy at the end of the day, but I need to see more signs of life in software. Thank you for the advice, Mav. Let's hope I get a small pullback in silver next week. I think you would. If the dollar pops, it will be so hard for gold and silver to fight the algorithms. So you see another drop in gold and silver. So once you get that ZSL position closer to positive or even break even, I would exit and just keep an SLV put. I think that's going to be, and keep it in a put debit spread too. That's going to give you a better exposure than having the inverse index. The inverse index was pretty good when we got that flush, but now I think you have to trade it, and honestly, it's a really, really hard skill to get it right every single time. Okay, folks, a lot of variables today. So we have OPEX, and we also have the Supreme Court decision. I'm waiting for the president's response. All of that is going to have impact in the market. But right now, at least from the mechanical perspective, you know that the market got caught by, market maker that is, got caught by surprise. See, they tried to exercise maximum pain, so they knocked off some of the calls. But at the end of the day, the pressure is way too high. The risk is too high, so they have to come as close as they can to that 690 before they try to exercise maximum pain on the rest of the calls. And I think that maybe it's not going to be 85. Maybe it's going to be a little bit higher at 87. To exercise maximum pain, if we go 87 here, we eliminate the majority of the puts. If we go to 87 here, eliminate a lot of the calls. So could be the target could move from 85 to 87 as maximum pain, but that's what I see in the dynamics today. The market maker wanted to stay at 85 or close to 85, but they got caught. See here? That algorithmic reaction, and now they just have to follow the risk management. The risk management says buy the ETF all the way to 690 so you can cover for that contract if we close above. And then you can sell at a profit. Once these guys begin to sell, you can sell and try to find a number to park in here to ensure that you have the best outcome for the market maker. But with that, folks, we'll be back in the closing hour. Maybe we're going to have a better discussion at that point because we're going to have clarity during the closing hour. And maybe we can make some market moves. So we'll see you then, folks, closing hour. But thank you for joining me for this stream right here. Appreciate and love all of you. Good luck and have a great weekend.